Virat, I think it is live now.
Yes, sir, you may start now.
Very good afternoon and welcome all for the two-day session on building capacity for chemical and allied sector, focusing upon chemical and allied sector. And basically it is on the trade finance and forex. We are fortunate to have distinguished speakers and Joint Secretary Shri Manish Chadha from Department of Commerce. I am sure this two-day workshop will help in building capacity and will help the Indian exporter realize its potential and understand the various intricacies related to trade finance and forex. Now, may I please invite Shri Vijay Kumar Guava, the Additional Director General Trade Promotion Council of India, to give the inaugural remark. Sir.
A very good afternoon to all. I take this opportunity to welcome Shri Manish Chadha, Joint Secretary, Department of Commerce, Ministry of Commerce and Industry, distinguished speakers, and our listeners and attendees. Trade Promotion Council of India is organizing a two-day workshop and training for the Indian exporters of chemicals and allied products. Exporters invariably face issues concerning trade finance and forex. And optimal knowledge about them would go a long way in smooth functioning of their businesses. Though this workshop shall deal with issues in general, TPCI is in readiness to take up and address specific issues as and when brought up by the exporters. I'm thankful to Department of Commerce for supporting this initiative under Market Access Initiative Scheme. The keynote address by Shri Manish Chadha surely will motivate the listeners and enthuse all of us. I'm sure his experience and expertise will help the government in well-rounding of policy formulations and execution in a big way. I'm also thankful to distinguished speakers who represent Ecgc, ICICI Bank, My Forex Fintech Private Limited, Shri Jagdish Bhatia, who agreed to share his experience at a very short notice. Hope these 2 days training and workshop will help that chemical and allied sector build up their capacities and contribute further to the export basket. Wishing you all a fruitful session. Thank you.
Thank you, sir, for your inaugural remark. Now, may I please request Shri Manish Chadha, Joint Secretary, Ministry of Commerce and Industry, Government of India, to give his keynote address. We are thankful for your presence, sir. Hope your presence will motivate and enthuse all the exporters who are listening to us. And also, we of great value to TPCI and other distinguished speakers. Sir, you may please continue.
Thank you. Shri Gauba, other eminent speakers and attendees. I'm extremely happy to address the vibrant chemicals and ceramic industry who have excelled in their endeavors of promoting Make in India and contributing to nation building. As I am amongst you, I would like to acknowledge that the Trade Promotion Council of India, with the support of MAI scheme of the Department of Commerce, is organizing this virtual workshop and training program on Export Finance and Forex Solution for Indian exporters of chemical and allied products. And I'm sure this shall benefit them in furthering their achievements and clarifying their doubts. To excel in economic growth, there is greater need for focused efforts to maintain our position and growth in world trade. The government is taking all the necessary steps to push industrial growth and encourage exports. Our strategy is to make the country less dependent on foreign products. The Government of India shall assist the industry to take up their submissions appropriately, and measures shall be taken in line with WTO regulations. The chemical industry in India is highly diversified, covering more than 80,000 commercial products broadly classified into bulk chemicals, specialty chemicals, agrochemicals, petrochemicals, polymers, and fertilizers. Indian chemical industry has grown exponentially in diversified manufacturing base, in sync with Make in India initiative of facilitating investment, raising the bar of skill development, and building state-of-the-art manufacturing technology. The chemical industry is the backbone of India's industrial and agricultural development. The size of Indian chemical industry is projected to reach US dollars 300 billion in 2025, registering a compounded annual growth rate of 9.3%. India is the sixth largest producer of chemicals in the world and the third in Asia. China has the largest chemical industries in the world, and we should try to enhance our manufacturing capability to become the largest producer in the world and also one of the biggest exporters. India's organic and inorganic chemical principal commodities exports from April till December 2021 showed an achievement of a record US dollars 21 billion. The Indian ceramic industry is around rupees 30,000 crores as estimated by the Industry Association. And globally it stands at number 2 and exporting tiles and sanitary wares to around 120 plus countries. Export of ceramic and allied products from India has reached US dollars 2.3 billion during 2020, showing a growth despite the COVID pandemic around the world. Export of ceramics and allied products reached to US dollars 500 million approximately, showing a growth of nearly 20% during April to December 2021 as compared to the same period of the previous year. The major products being exported from India are tiles, refractory bricks, ceramic products, sanitary ware, refractory materials, insulators, tableware, emery, and other products. The major market for Indian ceramic and allied products were the USA, the UAE, Germany, Turkey, Saudi Arabia, France, UK, Netherlands, and the Bangladesh. Indian ceramic industry is facing challenges with respect to anti-dumping duties leveled by GCC countries. The European Union and Indonesia are also proposing to levy duty against the Indian ceramic products. In order to facilitate export in this segment, export credit availability, capacity building, and knowledge dissemination is the need of the hour. I would like to appreciate TPCI's effort for organizing this session and hope that they would continue organizing such programs in future as well for the benefit of the Indian exporting community. Using virtual platforms instead of the traditional physical meetings and events that we were all used to for carrying out export promotion and business generation is a paradigm shift. And the sooner we accept and embrace it, the sooner we can realize the silver lining of trade potential hidden in this cloud. We should see this as a global transformation rather than the challenges it brings, since it may increase India's exports if this subtle opportunity is tapped into appropriately. There is a huge potential to diversify our export basket and tap into new markets. I'm sure these kind of sessions will help build much needed capacity and scale exports. I wish you all gain immensely from these sessions over the next 2 days and wish you and the organizers all the very best. Thank you.
Thank you, sir, for your intuitive address and the talking about the new paradigm shift, which is apparent and which is taking place quicker than expected. And we all are prepared to do most of our activities online, which we cannot do physically despite having the limitations. And many of the countries are still reeling under the headwinds of COVID. So this shift has to take place because business as usual cannot stop. Now coming to the export finance, it plays a crucial part in enabling the exporters in executing their orders, and export credit is required before and after the dispatch of the shipment. So this is a very crucial area, and the main problem is the post-shipment finance facilities in sustaining export business operations while waiting to receive the payment due to the foreign buyers. Commercial banking institutions has been an important source of credit. And people are facing a lot of issues. Reserve Bank of India regulates provisions of export credit by the commercial bank in India by stipulating some minimum proportion of their total lending to be provided as export finance. In India, export credit delivery system, short-term working capital credit requirement of the Indian exporter are mainly taken care by the scheduled commercial bank. However, the findings of the RBI survey of exporters satisfaction and bankers' views have identified many issues related to the existing export credit system. Streamlining internal system to expedite processing of export credit proposal ahead of the prescribed time, scheduled and further procedural simplification of the applications form and reduction in the data requirement from exporter have been expressed as some of the suggestions. Due to the complexity and diversity of export credit of foreign current procedures, exporters, customers often seek professional help from outside. And while small exporters have expressed their high level of satisfaction with respect to bankers' performance, but great focus needs to be placed on the region and product-specific credit availability. Now, TPCI has organized this workshop and training program with an objective of helping the exporter to avail the post-shipment credit institutional arrangement to migrate and impact the and to reduce the impact of the currency volatility and credit finance issues relating to honoring of letter of credit of overseas bank, e-commerce financing, technological intervention, credit financing, etc. So in presence of the August gathering of Joint Secretary of EPCAP and panelists who are expert in the respective field, the session shall aim to touch exporters from chemical and other sectors who may be relatively less informed in this aspect. So with this note, let me call our first speaker of the day. He is Gaurav Anshuman, Regional Head Delhi from Ecgc. He will be touching upon the areas like understanding the challenges in international financial transactions, solutions available for addressing the risks in export payments, open account trade, letter of credit, payment in advance, and insulating the exporter with credit risk through insurance. So, Shri Anshuman sir, floor is yours. You may please continue.
Thank you. Respected Jay sir, Samir sir, and other speakers and the participants. Very good afternoon to all of you. It's my pleasure to be part of this such a nice program that is being organized, because why I'm saying this, exports are the need of the hour. And if we really want to achieve the target of 5 trillion export figure by 5 billion, 1 trillion exports by next 5 years, and this financial years of $400 billion, and these chemical and allied products are going to be a crucial commodity to achieve this target. We all have seen that in recent past, the growth that this sector has shown is really remarkable, and we will continue to grow if the same pace and other commodities also helps, then it is not impossible that we will definitely surpass the 1 trillion export target set up by the government in next 5 years. Because this year itself, that $4 billion target, I think it's quite achievable, and we will be definitely surpassing this. And this stage, I would like to just share a small PPT with all of you. Just a minute. First of all, Mr. Samir has already given a brief about all what we are discussing about. So export is really challenging, and there are certain challenges in exports, not all the challenges, but the brief of some of the challenges that we are going to discuss is, first is the market identification, buyer selection, working capital requirement, and certain risks which are inherent in the nature of export, like political risk, commercial risk, marine risk, foreign exchange fluctuation risk. There are many other risks also involved in the export transactions, but we are restricting to few of the risks. So we all will know that where and how to handle all this. So market identification, as Mr. Samir was also saying, that the market is open and there are so many destination countries are available, and one has to push the product in the correct market. And then second important point comes the buyer selection, that if you are selecting a good importer there, then your role will be easier, and you will be further can compete in the market also. But to achieve anything, any of your business goals, finance is the biggest challenge. So working capital requirement will be there for every exporters, and that risk, that working capital requirement can be basically addressed by our commercial banks. And then certain risks are involved, like political risk, that the countries wherein you are exporting, you never know that what political situation will take a shape after the at the time when your consignment will be reaching, or some political changes is going on this country, that will also have impact on your transactions. Commercial risks are always there in any transactions, whether it's a domestic or international market. So commercial risk will always there. There are marine risk also involved in all the transactions, and then foreign exchange fluctuation risk will be there. So whenever there are risks, without risk, your profit margin will not be that much. So one option is you have to mitigate the risk. See, risk cannot be completely wiped out. You have to mitigate, you have to manage, right? One option will be avoid the risk. You do not take any risk, then you are out of the market. Second, you can accept the risk if you are comfortable enough and you are capable enough to handle such a risk. You can accept, then there is no problem. Other options will be transfer it or reduce it. Reduction means you are reducing your opportunities. So best way is transfer the risk. And then we will be seeing that what are the way ahead. We are now restricting only to the payment risk that is involved in the export market, in the export transactions. So basically there are two sort of things, sort of risk will be involved. The one is your payment can be stuck because of loss of goods, or your receivables are not coming, or it is coming for a lesser amount. Lesser amount may be come because of the exchange fluctuation, or payment risk, that your buyer has not made the full payment, or they have made only the partial payment, or entire payment has been held by the buyer. Similarly, goods risks are also there. If your goods have not been reached to the destination country, you are likely to face a payment problem also, because your importers are not going to make payment for the goods which they have not received. So when it is concerning to the goods, we have marine insurance cover available with us, and then exchange fluctuations can be very well covered through hedging. So when it comes to payment risk, it is the Export Credit Guarantee Corporation, ECGC Limited. Earlier we were known as Export Credit Guarantee Corporation of India Limited, but now it is ECGC Limited. And at this stage, I would like to introduce my company, that is ECGC Limited. The company was set up in 1957. It's a 100% owned Government of India company. We are registered with IRDAI also under miscellaneous general insurance miscellaneous category, and our working is under the administrative control of Ministry of Commerce. Our company is managed by a board of directors comprising representative of government, Reserve Bank, banking sector, insurance sector, and export community. Based on our claim paying ability, we have been accorded with IAAA rating by ICRA. So this is a brief introduction about my company. And the company is having a very clear vision to excel in providing export credit insurance and trade related services. And that vision statement itself is very crucial for any company or any organization. So if you see the vision of the company, it's that providing export credit insurance and trade related services. So we are not restricting only to the credit insurance part. It's a wide scope we have kept open, that trade related services. And with this vision, we have a mission statement that ECGC is to support the Indian export industry by providing cost-effective insurance and trade-related services to meet the growing needs of the Indian export market by optimal utilization of available resources. If you can see the vision and mission statement of the company, you can very well see that it is in the sync, and the company is working towards its vision and the mission statement. Why role of ECGC, and what is the role of ECGC and why ECGC is important? We need to understand that ECGC extends credit insurance cover to exporter against non-payment risk from the overseas buyer for the bank. See, one of the risks that we were seeing in the earlier slides, that the payment risk, because that the receivables are not coming from the buyer. So exporter will face financial loss, and that loss can be well covered through the products or insurance cover available offered by Ecgc, wherein we cover your protect your payment risk from the overseas buyer or the bank. At the same time, Ecgc also works as a facilitator. So in the previous slides, we were seeing that one of the challenges in export international market is that working capital requirement. So act of Ecgc here is as a facilitator, because we provide covers to the bank and other financial institution, which in turn gives export credit to the exporters. So with our support, the exporters are able to get this packing credit and post shipment advances at a concessional rate of interest, and bankers are encouraged to give it. So this way our facilitator role is there for any export transaction, even though we are not directly financing, or because we do not have this financing role. Our role is to provide insurance. So within our objectives and other things, we are facilitating the export through our covers given to bankers. So exporters are getting that working capital finance at a lesser interest rate or concessional rate of interest that banks are offering, because of export being treated as a priority sector lending. Ecgc also provides medium and long-term covers for project exports or the exports on deferred terms of payments. We also provide overseas investment insurance to exporters or Indian entrepreneurs in overseas ventures. As I said, that we are basically, our role is defined as insurance. So insurance will be basically dealing with underwriting. So in Ecgc also, our there are three pillars of our underwriting. One will be country underwriting, buyers underwriting, and exporters underwriting. Though I am saying that Ecgc role has been classified as like of insurance, but exactly we are not not the insurance company. You can well define us as an export credit agency of the country, and this is apart from Exim. Ecgc is the second. Apart from Exim, Ecgc is the export credit agency of the country. But as we have already registered ourselves under IRDI, our rules are similar to that of the insurance. So we will be checking our three underwriting pillars. Ecgc has developed our own indigenous country underwriting model, and for any country all over the world, we have certain parameters to examine the country. We evaluate the economic risk of the country. Therein, we measure the economic conditions of the country, and contains more than 10 economic factors responsible for growth of the country. Then we also see the political stability in the country, and by measuring political conditions of the country, we capture both quantitative and qualitative data, and we formulate some score, and based on this, then we go to the eco-political trade relation. That economic and political relation of the India with that country is also taken into consideration while classifying a country or rating a country, that where should place. And this eco-political trade relation has a major impact on the riskiness of the country from the export perspective. We also evaluate Ecgc experience in that particular country, and Ecgc is a member of Bern Union, which is an association of all these export credit agencies, wherein we share our data. So while rating a country, we take the experience of other credit insurance, which is known as the Bern Union. And then the forecast is also very crucial. So taking all this into some quantitative way, we measure a country, and we have a country classification of 7 groups. So right now we have a 7-group classification of all the countries, and more than 239 countries has been rated by Ecgc. So this rating is, any doubt? Somebody has unmuted. Please mute. So this country underwriting tool of ECGC gives rating of the countries. And as I said, there are 7 group in which countries have been classified. So the list risk will be in A1. So A1, A2, B1, B2, C1, C2, and D. These are the 7 groups based, depending on the scoring of the country and rating of the country. So this is A1 signifies less risk. And down the line, if you see that A2 will be slightly more, but still a low risk country, and D will be very high risk country. For example, I can say that A1 we have placed USA. Most of the European countries are in A1, and the risky countries like Afghanistan and others will be placed in D. Buyer underwriting is
Renuka,
also,
you please mute yourself. Renuka, may I please request you to mute yourself? Yes, sir. Please continue.
thank you, sir. So buyer's underwriting is also very crucial for an insurance company's perspective, because herein we are doing the direct services to the exporter. Because when we assess a buyer, we see the business ability of the buyer. We also see the financial strength of the buyer, their transactional behavior, and the industry wherein they are dealing. So while assessing the buyer ability, we check that what type of company the buyer company is, whether it's a ownership structure, nature of the company, legal obligations, and the agency through which we take rating from that buyer. They also provide their rating. We also check financial strength, that what is the financial position of the buyer. Depending on their financial position, it has all these factors have some numerical values involved and attached with them. So we, on each parameters, we give certain marks. And net worth of the company is also equally important, because when you are assessing or going to assume a risk, that net worth and sales, these are very, very crucial parameters. Income is also important. So based on all, we take this financial strength of the company. Transaction behavior, it includes experience of ECGC with the buyer. Maybe that one exporter who has come with a product demand, the buyer may be new for him, but the that other exporter from our country must be dealing with the buyer. So ECGC database, which is having around more than 5 lakh buyers on our record, and more than 3 lakhs 50,000 are active buyers on our records. On an average, we include around 18 or 15,000. I can say that on an average, we include new buyers every year. So it is one of the robust data that we are having, and we are working to increase it further. And exporters' experience with the ECGC. Suppose one exporter is with ECGC for quite long time. That the company is dealing with the buyer for quite some time, but ECGC may not have that much experience. So share of their experience also counted while we evaluate the buyer. And the industry also play that. What is the as I said, in country underwriting also we do that forecasting. So that based on that industry wherein the buyer company is dealing, that will also have impact, and it will have some numerical values involved. And based on all this data, we come out with some a score, and that score we call it as overall limit on the buyers. So that we fix after assessing a buyer, we fix an overall limit on the buyers, and then depending on the requirement of the exporters, it can be given to them. We have also this exporter underwriting. This ECGC maintains a specific approval list wherein any companies, any exporter firm or company who has come to our adverse notice, we keep a separate list for that, and we call it a specific approval list. It helps the Indian banks to lend or meet the financial requirement of the customers, and it is a handy tool for the banks, because if exporter is not there in ECGC, a specific approval list, it is easy for bank to they give it liberal finance to the banks, to the Indian exporters. Even if some exporters are coming to our specific approval list, there in some after with some underwriting and other, we may approve to the banks to finance the exporter. We also have exporter scorecard. So based on the exporters, you can say that entire profile, their net worth, their company profile and other things, we fix some score, and depending on that score, we provide cover to the exporters. Basically, two types of risk are being covered by Ecgc. One cover that we are giving is to the exporters, and the second cover that Ecgc is giving to the banks. In our covers to the bank, our role is basically of a facilitator, wherein we protect the banks who are lending to the Indian exporters for insolvency risk as well as the default of the borrower. Under exporter covers that we are giving to the exporters for their non-payment by the buyers, we basically covers political as well as commercial risk. Political situations are those situations wherein suppose the importing country is undergoing with civil war or some import restrictions, transfer delay, diversion of buyers, and this in commercial part, if you see that the default and insolvency of the LC opening bank or default of the LC opening bank, because these are the things which is covered by Ecgc, and all these risks are being covered through variety of products that the company is having on the shelf. Apart from the covers that for the exporter, we are having for both the segment, you can say that the short-term exports as well as medium and long-term, we are having covers available. For short-term, we have declaration-based policies, we have exposure-based policies, we have a specific shipment policies and consignment export policies. So these all are depending on the requirement and actual requirement of the exporter. Products are available with the Ecgc, and Ecgc has gone further to the extent that we can even customize the covers depending on the needs of the exporters. Of course, if you go for on higher end, so there will be some cost involved for anything, for any addition or any changes that you would like to have in your product. So basically, our product basket is sufficient enough to cater the needs of the industry. So most of our products that is we are offering to the exporter is protecting the exporter up to 90%, and cover to this small exporter is available for 95% also. So basically, the small scale exporter, we classify them that exporter whose annual turnover is not more than 5 crore is under this small scale exporter, and to them we offer our products with the coverage of 95%, and the declaration based covers are available for 90%, and exposure based covers will be available for 80%. All rest of all the policies will be with 80% cover. It's a co-insurance concept basically, wherein the stake of exporters are also taken into consideration. And one thing more, that it's a certain profit margins are also there, so some onus is left on the exporter so that they can also pursue the recovery action. And for the bank, we are also covering their fund-based facilities, that is of packing credit and post-shipment, and non-fund-based facility of the bank. By way of surety covers, we protect the banks. With these two covers given to the banks, the exporters find it it's supporting to the exporters, because Ecgc, based on the Ecgc or a strength of Ecgc covers, bankers are finding it easy to finance the exporters. Apart from that, this is the general things that is as a common exporter, what we have foreseen, that what are the risks involved in all this international terms of payment. So we have tried to capture it through this PowerPoint, that whenever any exporter is doing export on DP or CAD terms, most of the time exporter feels that there are very less risk or no risk, because documents title will be with exporter, so goods will be not delivered. So but exactly these are the risks involved in that the failure of your importer to take delivery of the goods, that is a risk, because still the title will be with you, but as an exporter you cannot do anything from here in India. You have to either bring back the goods or you have to resell it to any alternate buyer, if you at all get any buyer there. Insolvency of the buyer will always be a risk for any transaction. So after placing of order, if buyer company has become insolvent, your goods may not be delivered to the buyers, and the goods will have some loss, financial loss in the transaction. DA is slightly having more risk than the DP and DA, because herein failure to take or delivery of the goods will be there, as well as that insolvency of the buyer will be there, either at before taking delivery or after taking delivery, but before due date. If buyer company becomes insolvent, then payment is at risk. Then protected default by the buyer is always, it is possible in DA case, because after taking delivery, if buyer company is not making payment, you will be facing the problem, and that risk will be always there. Payment delay and part payment, yes, because you have given on a credit terms, and once buyer has taken delivery of the goods, it is not in your control to take your money as per your wishes and other things. If buyer company is not making the payment on time, then you will have to face the risk. Open delivery transactions are more or less having similar risk component than that of DA transaction. Only thing is, it's basically that documents have been routed directly to the buyer instead of involving your bank. But and letter of credit, as it's basically credit note given by the financial institution, so this discrepancy risk will be there. Default by LC opening bank and insolvency of the insolvency of the LC opening bank will be there. One thing here I would like to say that open delivery transaction nowadays, most of the time we have seen that most of the exporters are sending the document directly to the buyers. There is some regulation led by Reserve Bank of India that regarding sending of document directly to the buyers. RBI has not permitted all the exporter to send the document directly. What RBI Master Circular says that a status holder exporter can send the document directly to the buyer, whereas the non-status holder or the exporter who is not having this export house certification can send the document through their bank, provided their bank permits them, right? So nowhere it is mentioned that document will be sent directly to the buyer if exporter is not having a status hold. Many cases we are facing problem that exporters have sent the document directly, and now bank is not ready to regularize the transactions. So in the absence of regularization of that export documents or this dependency of regularization, even ECGC will not able to support the Indian exporter if exporter has taken policy from us. So these are the things that we have to be very, very cautious, that we should check that because why I am saying this, even though ECGC is giving cover to the exporters for failure of the buyers, and whenever any goods have been sent to the buyer and documents have been sent directly, though buyer has taken delivery and ECGC even it has covered the transaction, it will be ECGC will not entertain the claim, because this country's rules and regulation has to be followed up. We all know that the law of land will prevail upon any other terms and condition. So insurance sector, there are two that mandatory things. One is that IRDAI has stipulated that insurance premium has to be paid in advance, or even before commencement of the risk, you have to pay premium to the insurance company. Being registered under IRDAI also, this condition is applicable for ECGC also. At the same time, that RBI circular that I was referring earlier, that the dispatch of direct document has to be followed in the same spirit what it has been mentioned in the Reserve Bank of India Master Circular. With this, I am concluding, and your questions will be welcome. Thank you. Mr. Samir, you can take further from here. समीर जी, आवाज आ रही है?
Hello.
Yes, sir.
Thank you. Thank you so much, sir. We had some glitch here. Net was gone for a few minutes.
No issues.
Anyway, very intuitive and very informative presentation made by you. And I would request, I am getting so many chats that please share the presentation with us so that we mass mail it to all the listeners for later reference.
Sir, with your permission, we have some questions on screen.
Yeah. So we will take question answer session at the last of the session.
Right,
That's
sir.
the format.
That will be better.
Yeah, because in between it disrupts the flow.
Okay, sir. So I can request Mr. Manoj Kumar, who has raised the question, to keep his questions for the question answer session. We will address that time. Thank you, sir.
In case you are having paucity of time and you want to leave, you can address it now also, no problem. So it is as per your convenience.
So I will answer it right now, sir.
Yeah.
So first question is of from Manoj Kumar Melkani. His question is, how many days it required to execute Ecgc instrument? I couldn't get his question in totality. Perhaps he is asking that the procedural aspect of the issuance of policy, right? So for Ecgc policy, as an insurance company, a proposal has to be submitted to Ecgc nearest office, and based on the proposal, the policy will be issued to the exporter. Normally, it doesn't take much time. Second question is, what percentage of invoice value can be covered maximum? So cover is up to 80 or 90%, depending on the type of policy that the exporter has taken. His third question is, how many days it may take to get covered value of invoice in case of consignee is defaulted or any onward situation. So his question is basically related to the claim settlement. So now here also there are standard or 4-month waiting period will be there for any insurance cover to be matured from the due date. So after due date, 4 months period, after 4 months only the claim will be settled. As Ecgc claim settlements are based on the documents, it depends that how fast exporter is submitting the shipping documents related to that particular shipment. If documents are available, claims will be settled very fast, sir. We do not take much time, but a lot of time get consumed in the when exporter has not provided the required documents. Second question is from Mr. Mayur Bogra. His question is, can you explain more on challenges in export point? I couldn't get the specific question, and it can be addressed by other session also, or if you can elaborate, I can further give light on that. Third question is from Mr. Anand Kumar. His question is, what is the evaluation process before offering Ecgc cover? See, Ecgc cover, as I said, that Ecgc insurance cover is based on the underwriting of Ecgc. There are 2 underwriting involved in any export transaction or this insurance product that we are giving. In fact, 3 that underwriting pillars we explained. One is we assess the buyer, we check the country, and country information is readily available with us. Buyer information may take some time if it is already not there on our records, but normally 7 to 10 days is sufficient time to get the information on the buyer. So we can, and under many of the policy, we give some discretionary power to the exporters. So based on the policy that the exporter is taking, these inbuilt features will be there. So these are the questions that I am having right now. So
thank you, sir. Thank you. And
thank you, Mr. Samir.
Yeah, one question that our members have raised is regarding the honoring of LC by the banks. Some of the banks do not honor the LCs. So in that case, will Ecgc have any role?
Sir, discrepancies, see, basically LC is can be refuted on the basis of discrepancies also. Under certain policies issued by Ecgc, minor discrepancies are covered, but major discrepancies are not covered by any of the Ecgc policies. But default and insolvency of the foreign bank will be covered.
My second question to you is, supposing that you have blacklisted any buyer or exporter from your end, So, and like later on, he improves his credit score or whatever, and he is into now legitimate business. So, will ECGC change its, I mean, the tagging of? Is there
So
any?
first thing is that there is nothing called blacklisting in ECGC. It is a specific approval listing. So we need underwriting to do so. So we do not deny cover to any exporter uh, on the exporter to the bank. Similarly, buyers also, we say that we will underwrite, we will check the buyer and we will come back. So in case wherein some default has been reported or some adverse information is there with us on any buyer, on a later date, if the situation improve, we will also improve, because this is our bread and butter, sir. If we start keeping the buyers in our so-called blacklist and do not remove from them out from that, and exporters we are doing business with the buyer, we are the losers, sir. So it's a dynamic process, and we keep on updating the buyers record time to time. And in fact, this specific approval list, buyer's specific approval list, is a very handy tool for marketing. As I said, that one of the challenges in export international market is this correct selection of the buyer. If this exporter can see that adverse listed buyers from ECGC side, they can well design, or they can change the negotiation. Either they can negotiate on a better term, or they can avoid the risk simply by leaving that buyer and concentrating on some good buyers.
Absolutely, sir. Absolutely. Thank you so much for all
Thank you,
your
sir.
insights, and I am sure this deliberation will help the exporter to greater extent. So many people are still asking questions.
So, sir, one thing can be done. You can
Yes.
share my email ID with them. They can
Yeah.
simply raise their questions, and I promise to answer their queries, sir.
Right, sir.
Thank you, sir.
Thank you so much for your humility, and I will share the email ID with all the registered people who are listening to us, and you can contact Ansuman sir, who is so nice and ready to help you all. So thank you once again, sir, and I will get back and remain in touch with you. Thank you, sir. So our next speaker is, let me check whether he has joined or not. He is Mr. Jagdish Bhatia. He is the ex-banker, and he has worked with various banks like Standard Chartered Bank, National Bank of Sharjah, and HDFC Bank. And he also represented the Gujarat Chamber of Commerce. Now he is into creating the value for the other organization like FIO, other Predexil, EPC, etc. And he has guided almost 10,000 students. So Mr. Jagdish Bhatia is also owner of the Bhatia Export Training and Consultancy. So looking at his glorious career of spanning more than 45 years, he will be helping us, taking us through issues like availing the post-shipment credit, currency volatility and credit financing, issues of honoring LCs of different overseas banks, e-commerce financing, role of technology in credit financing, and suggestions for reconciliation of global financing ecosystem for trade. So, Mr. Bhatia, now floor is yours. You may please continue. Mr. Bhatia, are you there? I think he's yet to join because his time was from the 4 p.m. and Mr. Ansuman sir has wrapped up quickly. So till that time, let me inform you all that tomorrow we have a session with the ICICI Bank, and the other is My Eye Forex company, which specializes in the forex services and solutions. So forex is another area which is very dynamic, and it is a very fast moving kind of entity, and every day the exporters need to know the exchange rate and other things, and how to optimally manage it, and whether the technology intervention can really help. So all these will be taken up during the session tomorrow, same time between 3 to 6 p.m. So I will request everybody to attend both days of the sessions for the complete overhauling of it. Let me call Mr. Bhatia now. He said he will be joining by 4. So all of us can take 2-minute break.
But if someone wants questions, sir, I am ready to answer their questions.
Yeah. And Suman, sir, you may please take.
Yeah. So few more things I would like.
Hello,
because
Mr.
see,
Bhatia.
I thought
सर
that
आप ज्वाइन
I
कर लीजिए
welcome
सर, वो
more
थोड़ा पहले
questions.
खत्म कर
So
दिया इन्होंने,
मैंने
आपका
अपना
इंट्रोडक्शन
presentation
वगैरह
को
दे
पहले
दिया.
खत्म कर दिया.
हाँ.
So something other than what we have discussed so far. Basically, there are various type of products available for the exporters, and basically ECGC products are designed to support the Indian exporters only. For any size of exporter, different policies are there. It's not like that for big clients or for MSME segment, that is particularly the small scale exporters, our coverage are very high, that is 95%, and in case of political reason, the cover is up to 100%. So with ECGC support, the startups, the new entrants in the field of export, they can prosper very well. They can take, because in any export transaction, it goes without saying that there is certainly some around 10 to 15% your profit margins. So a small exporters taking ECGC policy, they are insulated up to 95% coverage. That cover will help them in case of non-payment by the buyer, or if payment comes, yes, they are already booking their profits, and this whatever profit margin they are having, they can do it. Apart from this normal covers and other things, ECGC is also there in factoring services. Factoring services are the products which is basically the factors will buy your receivables. So there are many factoring companies also in India, and they are operating even that many NBFCs can also do that. ECGC is also having factoring, its own factoring, and that earlier we were giving only to the manufacturer exporters, but we have also expand its ambit, and now we are giving to any exporters. And for factoring services, that exporter profile, buyer profile, everything is important, and that also helps some way in requirement, your working capital requirement. But I am saying that factoring cannot be a solution or substitute of your bank finance, that is the forfeiting business. But yes, it is a gap makeshift arrangement. If you are finding it difficult to get a bank finance and other things, then you can very well go to your factoring companies, and from there you can take the help of factoring, which will give you that immediate funding. This funding will be basically of three types of factoring services are available in our country. One will be with recourse, and one will be without recourse. So if you are getting any without recourse factoring facility, it is good, because here this credit insurance part is inbuilt, like our factoring, which is without recourse. Otherwise, mostly the factoring companies offers with recourse cover. So funding will be given to you, but in case of any complaints and other things from the buyer side, that onus will come on the exporter, and the factoring company will take back the money that they have lended to you. So factoring is also important tool, and particularly the short-term working capital requirement, it can meet your requirements. Other than this factoring, our insurance products are good. If you compare the bank finance and ECGC insurance product, together it will have cheaper. It is cheaper than the factoring services that one will be availing from the buyers. In a present scenario, what we have seen that the cases of insolvency has gone up. Till already I have completed more than 23 years in ECGC, but the cases of insolvency that I have seen in last one year, it is really, if I put together all my service experience and the cases that I would have noticed of insolvency, it is more what we have received in 1 year. Many big companies who were they were ruling that entire international arena had filed for Chapter 11 or Chapter 7, or they have simply wind up their operations. So these are the things wherein we have to be very, very cautious that insolvency, or particularly this Chapter 11 clause of US bankruptcy code, is very, 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 I can say that it is towards the American citizens rather than the suppliers, because once the Chapter 11, the company has filed Chapter 11, they will be legally protected from the any creditors. So as an exporter, if you are supplying to big buyers in US or any other European countries or any countries, one of the biggest challenges that of insolvency, because this COVID era has shown up different kind of business opportunity, at the same time different risks also. So your risk portfolio should be checked time to time, otherwise you will be left behind the rest, and tomorrow if anything goes wrong, you will be facing the trouble. So that is what I wanted to say, because I think Mr. Bhatia has already come, so I will not take his time.
Thank you so
sir.
much, sir. And I have already shared your email ID on the group. I will share another email ID, which is newdelhi@ecgc.in. So either of the email ID, you can reach to Ansuman sir on ECGC for further facilitation. Thank you so much for your address, sir, and it is of great help to all the exporting community, especially those listeners who have taken pain to go through the session and the workshop. So let me again welcome Mr. Jagdish Bhatia. I have already introduced you, sir, and he's a very distinguished speaker and has a illustrious career of spanning more than 46 years. He has been an ex-banker and now running a consultancy. I've already given a brief of your profile. So, sir, you may take through your presentation and your topics also I have informed. Yeah. Thank you so much.
Thank you very much. Is it my PPT is there on the screen?
No, sir, it is just a flyer.
Yeah, flyer. So
yeah,
this is about okay. It's the banking and finance. Okay.
Yeah, it is visible.
And I'm really thankful to Sami sir and TPCI for giving me this chance to give you the explanation about the banking and finance. I have already worked for 20 years in the banks in the Standard Chartered Bank in Dubai and HDFC Bank in Ahmedabad. And let us first talk about the MSME finance before I go into the finance of the export and import. So the people who are new, who do not know about what is the MSME, I'm just informing them that MSME is a micro, small, medium enterprise. A micro is called the under which the equipment and machinery, if you have invested, your investment is up to not more than 1 crore, you are called the micro, or the turnover not more than 5 lakhs rupees. And we will be talking about the small, who are the small exporters, I mean small establishment. Investment in plant and machinery equipment, not more than 10 crores or annual turnover not more than 50 crores is called the small enterprises. Medium enterprises are called whose particular investment in machinery and plant is not more than 50 crores and the turnover is not more than 250 crores. So this is the definition as on 1st July of 2020 in MSME. And we will be going ahead slowly and gradually about the other banking and finance, how the bank is giving finance. The core area was that when I was a banker, people were coming to me with a letter of credit or a confirmed order saying Sir, please give us the finance on that. Otherwise, how can we execute this order? So please remember, banks are not giving the finance in that way. You need to keep some mortgage over there with the bank, and then bank is financing on that. In the meantime, if you have received any first class LC bank from abroad, Standard Chartered Bank like, and you are asking the bank to finance you on that without creating a limit on that, bank will not finance you. It is only a piece of paper for the bank. So in the meantime, what bank says you create a limit, you keep some margin with us, otherwise you keep some property mortgage with us, and this is the way how the bank is financing. But under MSME, banks are giving the finance without a collateral secretary also, because if you would like to take the finance from the bank for the plant and machinery, then that plant and machinery will be kept with the bank as a mortgage of the property. So let us see first what is the MSME. It's industrial policy under investment schemes. It is assistance to the MSME, and assistance to MSME for the shade or plot with or without a GIDC. A scheme for market development assistance. Assistance for the startup and the innovation. Banks are giving a lot of benefits to you. Wherever you are banking, you can ask your bank which branch is handling the MSME finance. So you need to go over there and ask them the benefit which they are providing it to you. Even including if you are going with them to domestic trade fairs or the exhibitions or abroad to install your particular exhibition, then they get you the reimbursement of your fare ticket also, and at the lesser rate you can put your stall also overseas in the exhibitions and trade fairs. So assistant labor incentive industries is also there. Assistant to the industrial park. These are the main things which are given. There are other different types of investment and interest subsidies offered by the banks under MSME. So need not to be have a exporter or importer. MSME can work in a domestic also, but they can work as well in export also. So one need to contact the bank, asking about the MSME department and get more details on the MSME. Normally, they provide against the mortgage of the property. So loan installment is also provided up to 2 crores to invest in the plant, machinery, power plant, which itself will be kept as a mortgage of the property. The way we are taking the loan from the bank for a housing loan, they are not asking you to give us any property mortgage, because that particular home or office will be kept under as a mortgage of property. So first one has to put a plan and propose to the bank for approval. So who are the people who will get this finance from the bank? There are 3 types of the leverage bank provide. Number 1, project finance. I'm talking about the business, okay? Not about the home loan, car loan, or personal loan. So one is the project finance, capital goods, domestic. Export, it is called fund base. Non-fund base is called for the import, your bank guarantee order for your forward contracts. Unsecured loans for the domestic. You need to submit to the bank the full plan, and bank will decide whether you will be paying them back in installment of 12, 24, 36 months, depending upon your plan, and they will be deciding who and how much you will be producing out of that, how much money you will be getting out of it, and how you will be repaying that. And under this particular business installment lane, you need not to give any collateral security. Only primarily security is required. So that is called an undertaking. Promissory note that you will be paying them during that much amount. So who can apply this loan? Business of the existence of 3 years. Any new person will go to them and ask them to give us a loan for project loan. They will not give. Bank need to know how much experience do you have in that. So 3 years experience, manufacturing people should have the annual turnover of 60 lakhs for last 3 years. The people who are the services, their gross receipt should be 50 lakhs rupees per annum. They are also getting. Let me tell you one thing here. I have noticed one thing that people are not aware that service export is also going from India to abroad. How come? The very surprisingly, people are not aware that India's out of a total export of India, 37% is only service export. So the people who think that they do not have much funds, they can enter into the particular service sector. Service, you don't need to buy the things, you need to only apply your particular proficiency here. So please note that 37% our service export is done out of the whole export from India. Under business installment loan, Reserve Bank of India is asking you to give us the very easy documentations. Reserve Bank of India KYC requirement, last 2 years audited financial bank statement. Bank loans if you have availed from any other banks. So that is also needed to be given there. Primary security undertaking that I told you, promissory note only. And loan application, loan agreement and hypothecation deed. That is a mortgage. They will take the thing which you are going to buy. They may pay directly to the people from whom you are buying. So that will be kept originally at their own name who are providing you the loan, banks or financial institutes. So how finance is decided by the bank? Whenever you are giving any property, a mortgage to the bank, they are taking the valuation that we call it in Hindi is a jantri. There are valuation people who are making the valuation of that property. If I have a property in the center of the city, maybe more than what we are having in a remote area. So they will tell you, tell the bank that this property valuation is this much, and out of that, bank will give you only 80%. They will keep the 20% margin of it. I will take one example so that it will be easy for you to understand. Suppose you have given one office or one very building or a house or land, and they had taken the valuation of that particular property as 1 crore. Bank will give you the loan up to 80 lakhs only, 80% of that particular valuation. And then they will ask you how much you want it for export or how much you want it for import. It is you who will have to declare at this stage. So once this property, this sanction letter is given to you, you cannot go interchangeability with export with import or import with export. So this is point is also to be noted. You know better how much you will be importing, or you know better how much you will be exporting it. This is the way and a graphic which you should know about the export finance. Okay, export import finance, banks are giving two finances to you. One is fund based, other is non-fund based. Under fund based, there are two chapters like pre-shipment finance and post-shipment finance. Again, under pre-shipment finance, there is two types of finance banks are giving. Under INR and under PCFC, packing, protecting foreign currency, and other is here the post-shipment finance. Under non-fund finance, it is import, and that is called under LC, bank guarantee or forward contract. I will tell you why this word has been used as a fund based or non-fund based. Under a fund based, the bank provides you the fund directly into your account to go and procure the material and export it. Under non-fund basis, they are not providing you any fund directly into your account. They are taking guarantee on your behalf under LC if you are importing. They are giving a guarantee on your behalf to the supplier abroad that if you supply so and so things and you submit us so and so documents, we will be paying you the amount of the buyer. So that is why, because they are not funding it to you, so it is called non-fund based. We will be going in detail about all these chapters today. What is fund based according to Reserve Bank of India? What is pre-shipment finance? How the rates are decided? When you are supposed to give money back to them? How much credit facility you can offer to your buyer under LC or non import and under export also. So under export, you can offer the credit facility of only up to 270 days, 9 months only. Under import, you can take only 180 days, that is 6 months only. So that is very clear. First, we will be taking the subject of fund-based limit. I told you there are two chapters under fund-based limited: pre-shipment finance and post-shipment finance. Pre-shipment. So before shipment, what are the fund you are getting it from the bank is called pre-shipment finance. Post-shipment finance, goods have been shipped, yet money has to come. You can discount that document and you can get the fund from the bank, and that's why it is called post-shipment finance. First, we will be talking about the pre-shipment document. What is pre-shipment finance? Again, there are two types. I told you pre-shipment finance under INR, I mean in rupees, Indian rupees, and other you are getting the PCFC, packing credit in foreign currency. We will be going into detail now. So first we will talk about the pre-shipment finance under rupee. That is called in banking language, it is called EPC, export packing credit. So when I say export packing credit, it means you are getting finance from the bank. Loan is given by the bank to you to purchase, to process, to manufacture, or a packing of the goods prior to shipment. So before you are making any shipment, you can use these funds for purchase of the material, for processing the material, for manufacturing, for packing of the goods prior to shipment. Loan is granted against the LCs or confirmed order. Even your bank is giving you the sanction letter. Don't jump to take all the funds from the bank. Only take as and when you need. The reason is the day you have taken the money, days will be counted from there, and you need to return the money to bank after getting that money back from abroad. Number one. Number two, your interest will start from that day. So when sanction letter is coming, just take the money as and when required by you. So sometimes banks are waiving this particular LC and confirmed orders under export packing credit or lump sum amount for the big exporter. If you are a big exporter, they will not. You may not have the confirmed LC or order right now in your hand. That may be in summer when we are getting mango. If you are working in a mango season, you will go to bank. Sir, I don't have the orders and LCs now, but mango I am dealing in, so I need all the funds right now because I want to procure all the mango now so that I can put it into the refer, and then and subsequently order when they will come, I will be supplying. So bank may consider and they can give you the full sanction limit on without the confirmed orders also. But remember, this is as a bank's discretion. One thing is there, after 2012, I have noticed that all Reserve Bank of India has given a discretion power to banks, including charges also. So one bank, 10 customer, all 10 customers, they are charging difference. Charges are different, rate of interest is different. So remember, bank charges and interest are unnegotiable. A person who is giving more business to bank is charging them less. So you should remember that you can negotiate about the interest rate, you can negotiate about the charges, you can negotiate about the forward contract when you are booking with the bank, about the margin they are charging to you, you can negotiate. It is a negotiable. Bank to bank also, one bank with a different customer, different rates. Okay, now prior loan for a period of loan, I told you, they provide you the loan for 9 months. So this is RBI rule. I am talking about the normal cases. Okay, that sometimes it may be very big also, but then you will have to submit a report, a project report to bank. That, for example, if you have been given an order to put all the street lights in the whole city, it will not be completed within 9 months. So you can ask them to give the more period. But in normal cases, it is only 9 months. Subject, you have to bring the back money within 9 months only. If a loan is not paid within 270 days, that is 9 months, domestic rate of commercial rate of interest will apply here with a 1% penalty. Why? If you are getting any subsidy from the bank, like if you are an export, if you are getting a subsidy, 416 items have been given the subsidy to take the loan from the banks. For manufacturer 5% and the merchant exporter 3%. So you are getting the loan at the subsidy rate. So what you do? You have to bring the money within 9 months only. And if you are unable to bring that money within 9 months, you need to pay that money particular to bank with the penalty with the rate of interest of local. We will be taking one example to easily understand this. Suppose HDFC Bank is having 10% rate of the interest for the domestic business, okay? And you went to bank and you ask them to provide us the loan for export. So if you are a manufacturer, they will give you at the 5% because 5% minus. If you are a merchant, 3% minus 7%. Okay. So suppose if you are a manufacturer, so they are charging you at a 5%. But you could not bring the money back to by exporting and getting money back from abroad from the buyer within 9 months of time. Bank will charge you that loan at the 10% as a domestic commercial rate of interest plus 1% penalty. So you will be asked to pay to the bank at the 11%. So this is the way how banks are working. Liquidation. What is the liquidation meaning? The liquidation should be out of export proceeds. It means you have to export the goods. You have to bring the goods money outside from outside India, or you can discount the document once you have exported. So your general ledger account of the bank about EPC, export packing credit, has been debited to your account. Now you can convert this EPC, pre-shipment finance, into the post-shipment finance if you made the shipment. Discount that document and get your EPC credited. Okay, this is the other way you can get the liquidation. Other way, if you are having in any EEFC account with your bank, exchange on a foreign currency account. If you are holding any fund in EEFC account, you can close this loan. But one should know what is this EEFC account. So let us understand what is this EEFC account. Exchange earners foreign currency account. Okay. Whatever the fund you are receiving for export purpose, you can credit these under EEFC account. You can open any currencies EEFC accounts. It means this will remain in the foreign currency itself. Suppose I am opening a dollar account with my bank. If I am an exporter, my money is coming for the export for advance also and for the realization of export bills. I can keep the dollars into my EEFC account. This will remain as a dollar only. It will not be rupee. It will be dollar only. But if I have raised any loan or investment from abroad, that cannot be kept into this particular account. Okay, only export proceeds. And what are the other features of this account? People are opening mostly euro and dollar because 80% of the world trade from India is done only in US dollar. To Europe, 15%. And rest of the 22 currencies are there, 20 currencies are there. So people are not working in other currencies. Okay. So under EEFC account, you can open this with a zero balance. You will not be getting any current interest, interest because it is a current account. If you are holding any balance under EEFC account, no credit facility will be given to you. You can credit full amount of your export bill. Please remember, if you do not inform your bank, and if in January, for example, if in January, if you receive all the funds, whatever the funds you receive today, in January, I mean calendar month, on the next month, the last date, the bank will automatically take out that all your dollars and put it into your rupee account if you do not inform them. Sir, ऐसा कैसे करेंगे? This is the rule from the Reserve Bank of India. But if you want to maintain that, then you will have to inform your bank. Sir, I have kept this fund for so and so purpose. Then bank will not do. So at least 1 week prior to finish out that particular month. Suppose this is January, from 1st January, 31st January, you receive whatever the amount, you put into an EEFC account. Next month of February, 28th February, they will convert this from dollar to rupee account. But if you want to keep it, inform to the bank, say by 20th or 22nd February. Because India needs a foreign currency funds. India is not having that much foreign currencies. So our import is more, our export is less. It is a 60% is import, 40% is 40% is export, and 60% is import. We are 20% a deficit. So this is the reason, and why people keep dollar in parking in EEFC account, to save the exchange cost. If I'm importing something, I can pay from dollar to dollar. I'm not buying dollar from bank because I already received the dollar against my export. So I'm saving the exchange commission over here. Number two, what other people do. Suppose that today I think that this dollar will shoot up within 2-3 days. Today's rate I saw that 74.69. And as a businessman, if I think dollar will be shooting up, I can park my dollar funds, inward funds into EEFC account. And if it shoots up on that day, I can say bank, please convert this today with today's date and put it into buy. So some people are doing that also. And other benefit what we were on the subject was paying the packing credit. And I repay the export packing credit, what you have taken the loan. But why bank is allowing you to close your loan of export from this account? What was the rule? Bring the money dollar from outside India. And what are the credit will go into EFC account? Only those funds which will be coming out of India only for export proceeds. So you can close your EEFC, any money, any orders money can be given to bank back for closing your INR loan or PCFC loan also. So PCFC I'm coming, what is that? Running packing credit account. Bank will give you the seasonal material, which I told you recently about the mango, this thing. But that is by the judgment of the bank, without insisting the LC or order. FIFO basis is a first in, first out. Suppose you have taken 3 loans, for example, 1st January, 1st February, and 1st March. 1st January you exported, so that loan will be closed. Now, say 1st February, whatever the loan you have availed from the bank, that is yet to be shipped. And you shipped by the time 1st March order shipment. Bank will close the loan of 1st February, and that is called FIFO basis, first in, first out. Even though this 1st February order is yet to be shipped, but shipment of the 1st March has been effected, so your loan can be closed of the 1st February. So now you got the knowledge about this. Knowledge has a power. You can tell the bank, please, according to RBI circular, you close my 1st February, first which I have taken the loan. So you are saving a time over here, and so that you can save the unnecessarily penalty and the commercial debt of interest. Non-compliance. Whatever I'm teaching you is all from the Reserve Bank of India rules and regulation about the giving you the finance. Okay. So in case of the non-compliance of the rules, the facility will be withdrawn. But what is the meaning of non-compliance? Using the funds purpose such as domestic transaction. 1 minute. Sorry. You have taken the money from the bank for export and you are using those funds for domestic. Not allowed. So now how bank will know? Bank can see your statement to whom you have paid and what have you done with those goods. Or not submitting the document with 270 days, 9 months. So you will be charged penalty. 1 consignment, 2 suppliers. I am buying from somebody. So he can also take the loan from the bank. I can also take the bank. Not allowed. It is the running packing credit account is not given to sub-suppliers. Either one of us can take it because goods are one only. Partial domestic sale. It's a very interesting subject here now. I am sitting here in Ahmedabad in Gujarat. Example, okay. Now I'm here already there, but example I'm giving you. I bought wheat from Punjab with gunny bags. I paid to supplier in Punjab gunny bags by the loan which I availed from my bank. And what I told my bank, I'm going to export these goods. I'm going to procure these goods. I paid out of those funds. Okay. My shipment is in bulk. It is not in under break bulk. It means I'm not shipping the gunny bags. I'm supplying only wheat. It means all the wheat bags will be going to the ship. It will be put, the wheat will be put, and the whole bags will be brought back. So bank said, sir, you have taken this money, but this bags you have also paid out of these funds. On that, we will be charging you the commercial rate of interest. So whatever the banks I will be selling domestically, banks will be charging me domestically rate. How will they know? You have paid, you have shown the bill to bank that I have bought so many bags of the wheat. And then you are showing the export document also where it is written as a bulk shipment. The bank will know about this also. Post shipment finance, shipment is done, goods have gone. On that also you can avail the finance if you are not availed. But if you have availed EPC, export packing credit, pre-shipment, you can convert this post shipment. Shipment has gone, document are in your hand, give it to bank, tell them discount this document and close our EPC, export packing credit, pre-shipment finance. This is allowed. So you are again 270 days starts from today, the day you provide the export document to your bank. Now how? For what period they can give it to you? Period is bank may grant advance against duty drawback also. Against, and sometime your duty drawback is shown on the system of the DGFT. Bank is giving the finance also on that also. What are the period of post shipment finance? Under the payment term of your DP or at site, you are getting the payment within 25 days because the site payment. Banks are providing you loan for 25 days only. So if you do not bring the money back within 25 days, they will debit your account. People say if there are no funds in my account, then what bank will do? Your bank balance will go in minus and commercial rate of interest will start with a penalty. And if you have given any credit facility to buyer, the payment, credit facility will be given to you under post shipment finance up to that particular period of not more than 270 days. Consignment export. Consignment export is allowed without payment terms to the exporter. What is consignment export? Whenever you are supplying your export to your offices, your own offices or your agents abroad or distributors, that is called a consignment export. They will get all your particular products. They will keep on selling in domestic market and they will be submitting money back to you here, reimbursing the money back to you here. But for that, the Reserve Bank of India has allowed you not 9 months, but 15 months. So you have to bring that money back within 15 months of time. Ecgc cover. I did not hear the person. I'm really sorry about that. But Ecgc premium for the post shipment has to be taken, is to be bear by the bank, not by you. Okay, remember that. Some of the banks, what they do, if they give you pre-shipment finance, it's okay because you are taking the Ecgc on the buyers. Under post-shipment finance, bank is taking credit from Ecgc, but premium need to be paid by the bank, not by you. So remember, if you get any debit advice from the bank under post-shipment finance, and they debit your account with the Ecgc premium, ask them to give you refund. So this is RBI's rule. If a post-shipment finance is overdue, what will happen? If bills are not paid within 25 days, they will debit your account and same will be crystallized. Crystallized means debiting your account with those much funds. Interest rates of the export, how the banks are deciding the interest rates. Okay, Banks are free to decide the rate of interest above the internal marginal cost of funds. That is called MCLR rates. So the normal current rate of the bank is MCLR plus 0.5%. For example, if a bank's MCLR rate is 10%, they will charge you 10.50% minus if you are getting any subsidy from RBI. Manufacturers are getting 5% and merchants are getting 3%. So they are charging in this way. This is the way how bank they charge you. MSME, it is minus 5%. Early payment, yes, you can do the early payment to your bank. And you can get the refund of your interest also. This is a good thing again. Labor is no more. Labor has been stopped from 31st of December. So banks are authorized to charge you the international rate, what is going on that particular currency. So labor has been stopped from 31st December of 2021. From 1st January 2021, banks are allowed to charge you with the interest rate going on that particular foreign currency. PCFC, taking credit in foreign currency. Pre-shipment and post-shipment finance is allowed in foreign currency as the rates are very competitive. But what is PCFC? See, I will tell you what is the difference between INR loan given by the bank or PCFC given by the bank. Banks are having two types of funds with them. Whatever the fixed deposits we are keeping with bank, whatever the amount we are keeping as a domestic individual Indians, they are having INR funds with them. Out of that, they are giving us 6%, approximately 5 to 6%. So their marginal funds are coming about 5 to 6%. But they are having the fund of the FDI and NRIs. Those dollars they are having with them. And those funds, they are with them at the lower, because a fixed deposit of dollar is only hardly 2%. INR fixed deposit is approximately 5 to 6%. So if you ask them to give me the PCFC loan from your dollar fund, they are not giving you in dollar, but they are converting it with today's rate. How much you are earning if you only simply ask your bank to give me loan in PCFC, just only by putting in a letter. Just say, give me PCFC, that's all. So you are earning 3% loan at the discounted rate. Always ask your bank to give me PCFC. Never ask to give me EPC. Gold scheme card. A gold card scheme is offered by the banks to the credit-worthy exporters, including small and medium. What is that? To enjoy the simplified procedure at a low rate of interest, you are also getting a 20% ad hoc limit, whatever already has been sanctioned from time to time. Non-fund based limit. Banks are not providing you any loan on that, but they take a guarantee on your behalf under LC by issuing you the shipping indemnity, because they are giving a guarantee to shipping companies to give you the delivery of the goods, and issuing bank guarantees on your behalf. No need to give any money, don't need to give any cash collateral security. Only that particular sanction limit they are debiting in the general ledger account. They are providing you bank guarantees also. Forward contract. Oh, very interesting again. If you are booking a forward contract with your bank, bank is not debiting general ledger of amount of the total full amount of the forward contract amount. No. Only the 10% of fluctuation. Today is 76, approximately $75. Okay. So if you are booking a forward contract with your bank for $1 lakh, suppose for example, bank will not debit your $1 lakh in your non-fund based limit. They will debit only 10% of 1 lakh, so 10,000, because fluctuation can come not more than 10%. Have you ever heard 10%? But for the sake to understand, 10% they are booking the forward contract as a liability. So remember this, this forward contract fluctuation rate is also can be booked, and how that is booked we are taking within few minutes. Supplier's credit, fantastic subject I'm going to teach you today. If you are an exporter and the importer is asking you to pay me immediately, that you are asking him to pay immediately, he's saying, no, I will pay you after 6 months. But if it is only under LC, this will work. Tell them to give you the LC of the very good bank. You tell his bank to discount the document and pay you immediately by deducting the interest rate for the 6 months. That can be done. I am explaining you in detail. Suppose you are working here with HDFC Bank and abroad that particular person is working in Hong Kong, some HSBC Bank. HSBC, you have got it, you have supplied it, and payment term is 180 days. It means you will be getting payment after 180 days. You tell HSBC Bank to discount this document because anyway HSBC Bank has to pay you after 6 months. And if you tell them that I will pay you the interest rate for the 6 months if you are paying me today, bank will be more than happy. Why? They got the fund, they got the business. Anyway, they will have to pay it because they are under LC. So you can do in this way also. You will be getting the orders also because Hong Kong party is saying I will pay after 180 days. So that is the headache of the HSBC Bank and the buyer. I'll be getting money. I'll be getting liquidation of the funds. No tension after 6 months. What will happen? Coming to buyer's credit. What is buyer's credit? Now I'm importing. My bank is HDFC and his bank is HSBC. Under import, my HDFC bank is opening the LC. Okay. I am telling my supplier, I will pay you after 180 days. Buyer say, that supplier, Hong Kong supplier said, no, I want immediate. Again, I will go to HSBC bank. Please discount this document. You are getting a LC from HDFC. They will be paying you on after 6 months. It's a bank's guarantee. Definitely, they will discount the LC because HDFC is one of the top 10 banks in India. You secure your order. You will have to pay to your HDFC bank only after 6 months. So that is called a buyer's credit. Why you should do buyer's and seller's credit? You are getting the document discounted abroad at a very lesser rate, hardly 3 to 4%. Everybody is taking the advantage of this. If you are not taking the advantages, please go. Please do this. Issue the different overseas bank LCs. Why the banks are not taking the this risk? Because other banks is a very low rating. Sometimes we are getting the LCs of the non-banking financial institutions also. So banks are not discounting those documents. They are not having any credit exposure with those banks. How can they discount it? And that is the reason they are asking you to get this LC confirmed by some international bank. They are not having any credit line with them. But sometimes they may grant with recourse. If you are a very good customer doing a very good business with the banks, bank will grant you with a recourse. What is the recourse means? If I do not get the money with a stipulated time from that bank, I will debit your account. But if it is a very good bank, like international bank, top 100 banks, you can see on the almanac of banks on Google rating. What is the rate? What is the particular bank's rating on that? So depending on the credit worthiness of the exporter, by taking Ecgc on post shipment finance, anyway they will take premium payable by the exporter because they are taking the exposure on you, on your request. So remember, banks are not discounting the document. Some banks are very mischievous by finding out the discrepancy in our and discrepancy. I know it's a very big issue is going on in the international market. What the survey says of 2021, international survey of the bank says whatever the document have been submitted by the exporters to the banks under LC, 90% documents were discrepant. My God, 90% documents were discrepant. So I know that buyer is accepting the discrepancy because he is concerned about his goods, not about the bank discrepancy and all. But banks are earning, there's one clause always in a bank in LC. Discrepancy fees of so and so will be deducted from your. So 90% documents in the world and submitted under LC are discrete. So if you are a master of the making the document under LC, I know when I was in the bank also more than 90%. Which bank, which countries documents I was getting in a perfect way? Japan, Germany, Europe, and mostly China and USA. These are only the countries who were submitting document very nicely, fantastically. Foreign exchange risk, yeah. 74, 75, it is running on. So let us understand about the foreign exchange risk management. What is foreign exchange risk management? It is a loss that international transaction may occur due to the currency fluctuation. Currency keeps on fluctuating. Nobody knows. Even American president or Indian finance minister, nobody knows where dollar will go. It all depends upon the demand and supply. It means floating of the exchange rates going up and down. To control the same today itself is called a foreign exchange risk management. If the rate is going up, exporter is gaining, but simultaneously the importer is making a loss. If a rate is going up, importer is doing a loss and the exporter is getting gain. So this is the way how these things are going on. Whenever the dollar is going up now, for 2-3 days it went up to 76 also, all the exporters were happy. But my dear friend, India is losing because our dollar, our import is more, we are paying more to outside countries. So why the dollar is going up? Oh, let me give you one fantastic example here. 15th August 1947 was our Independence Day. On that day, dollar to rupee rate was 1:1. $1 is equal to 1 rupee. Today 70, it is just to 75. So $1, I mean 1 rupee per year has been depreciated. Why? Because our import is more, our export is less. And that is the reason, unless and until our export and import both will be same, this will not keep on stable. Or if our export is increased, our import is reduced, then this rate will go down. So don't be happy if the dollar is going from 76, 77. Exporters will be happy because they are getting more rupees. But our import is more. What is the number one import we are doing? Oil, petrol. Out of 100%, whatever the consumption of India's petrol is there, 85% we are importing. So 15% we are only having with us. We are having our own 85%. But why to import gold? It's a dead investment. Machinery, I understand. Yeah, machinery we need it. But we can make it ourselves also. So make it in India is also going on. How the foreign exchange position can be managed? If you keep the position unmanaged, your profitable export and import transaction cannot enter the loss, depending upon the exchange rate is favorable or unfavorable on that particular date of the conversation. So forex market is totally unpredictable like share market. It is going up and down directionless movements. So to keep these two ways, I already told you about the EFC account and booking the forward contract. EFC account we will discuss, so we will be going directly on the forward contract. What is forward contract? It is a contract between the bank and you, which exchange conversion of the currency would take place at the future date. At the fixed rate, what we are going to fix it today. Forward contract can be booked up for 30 days maximum. 30 days can be controlled from, not from 1st to 30. It can be from 15 to 14, 20 to 19. This way you can you can do the forward booking, and that can be done up to 1 year only. 1 year also you can book it, but the fluctuation of that period can be 30 days. Okay, this is the example of how to book a forward contract, how to book the foreign exchange risk management. This is the way. Suppose today's dollar rate is 74. Okay, if you're telling your bank, my money will be coming after 6 months, what bank is doing, bank is adding the $2 as a 6 months forward premium into that today's dollar rate. So what is the rate of future after 6 months? It is 76. 6 months from today, the dollar rate will be 76 because that dollar is always appreciating and rupee is always depreciating. This is the motto. Bank is not doing business is said like that only, because they will be charging their own commission also. So bank is charging you approximately from 10 paisa to 50 paisa also. So that is also negotiable. You can negotiate with your bank. Okay. Now, for example, if you are charging your bank, telling your bank to book the forward contract for export for 6 months, what they will do? They will minus 10 paisa from the 76 rates of the 6 months, and they will give you today itself 75.90. I will give you after six months. So you are fixed. Whatever the rate will be running on that day after 6 months of dollar rate, whether it goes to 80 or it goes to 70, you will be getting fixed rate of 75.90. Clear? But if you are importing, if you tell the bank, I want the forward contract booking for import, they will add their margin of 10 paisa into 76 and they will give you 76.10 for import. You are fixed. Whatever the rate will go after 6 months, you are buying the dollars from the bank, they will sell you at 76.10. And that rate is fixed today itself. And always never keep position open. Keeping position open is a very risky. You don't know, you are playing a blind game. So never keep any position open. Always you are doing a business, concentrate on your business, do the business, book the forward contract, do the other risk managements also immediately when the contract is finalized. So what are the other risk management under export? Number one, Ecgc. You take the Ecgc first on buyer, buyer's bank, country. Number two, immediately book the forward contract. Okay. And number three, marine insurance. Number four, inspection of the cargo. Cargo rejection risk is also there. So always manage all your risk and then do the export business. And this is my advice to you, all of you. Thank you very much indeed. My introduction has been already given. Standard Chartered Bank I worked with. I worked with HDFC Bank. I am delivering the lecture at Gujarat Chamber of Commerce, Bombay Chamber of Commerce, Gujarat FIO, APC, MSME, ADI, and all. I made some videos for you. I will be sharing this PPT with the TPCI. I will be sending it to you. How the debt recovery can be covered, what is the TT payment, how to do the export safely, now what is the LC transition and all. So I am personally giving the consultancies and training also, distant training also. You can contact me if you are having any question on, if you are having any question, we'll be taking it right now. Thank you very much indeed, Samir sir. We will be taking any questions if they are having, please.
Thank you so much, sir, for
Thank
your very good presentation and the way you explained and the experience you shared with all of us. I am sure this will help the exporters go long way in understanding the intricacy of finance and many new things which you could explain very well will add value to their business. I can't see a lot of questions. One question is, what are the rules for export financing for goods sent through e-commerce?
The e-commerce rules and regulations are the same what we have taught you right now. There is no changes at all for e-commerce. There are no different rates for e-commerce.
Now, other question is what
interest submission. Yeah, I can read it. I will read it. No problem. What is the status of interest submission, packing credit, MSME? Government of India has issued the news letter on last week, which I have read it. It has been stopped from, not stopped, I should say. It has been going on with the government of India. Government of India has not given any renewal from the 30 September of 2021, but Sitaraman has said in Economic Times that they are considering this thing, and under foreign trade policy, and RBI is going to renew this from 1st October 2021, and you will be getting it. Definitely you will be getting it because it's a headline on the last week on the newspaper of the Economic Times. So what is the other question? I'll read it now. What is interest submission? Okay. Okay. Ecgc forward contract marine insurance. And fourth is you're taking the goods of inspection of the cargo. Okay. So where we can get the updated RBI Master Circular for Export online study. It is on RBI's website. It is already available on the Reserve Bank of India's website. Latest master circular on export-import finance is the subject. Does a bank charge for generating EBRC? Yes, some banks are charging, some banks are not charging. Some bank charges are 300 rupees to 1,500 also, but it is negotiable. You can negotiate with your bank. Please suggest a forward contract transaction limit or period. Limit is up to maximum 1 year. You can book the forward contract, and the fluctuation of the days is 30 days. Because I will not be knowing on what fixed date my payment will be coming, isn't it? So you can do the 30 days fluctuation date. Okay. Can you explain the procedure for export factoring? Export factoring, we cannot take it today because export factoring is what I told you of the same thing. Buyer's credit and supplier's credit is called a factoring. Okay, it is done with the recourse. Factoring means a buyer's credit and supplier's credit, which I explained to you right now. So you can go through that again. Forward contract maximum time limit. I told you 1 year. Is EBRC applicable for Nepal and INR transition? EBRC is yes. EBRC is applicable for all transition, including Nepal. Under INR, you will not be getting any government incentives because it's a rule, government rules. People are not aware about the banking finance, government rules, that you will not be getting any type of RODTP if you are doing the billing in INR, except in case of Iran. Only Iran is the country where you can bill in INR. If you do the billing in INR to Nepal, you will not be getting any government subsidies. Subsidy, I mean incentives. Okay. Sir, since September, government has not renewed EPC scheme. So bank has stopped the subsidy rate. What should we do? I told you, no, right now, just now, that there is a very big headlines in Economic Times last week that Sitaraman has said we are considering this and it will be renewed. So definitely it is coming by end of this month. Definitely it will come. So no need to worry about that. Can you tell me how FX swaps are done and for what purpose they are done? Okay, FX swaps, Forex swaps. If you book the forward contract for dollar and if your payment is coming in euro, so that is called a swaps. The currency to currency rate are applied over there. So similarly, there is no any botheration about that. Dollar to euro, euro to dollar, dollar to yen. You can swap the currency from one currency to other currency. Is the GR waiver applicable for export of value more than 25,000 or free of cost of supply? Yes. GR waiver is must. Government, I will tell you one thing here. Custom says something else, DGFT says something else, and RBI says something else for the GR waiver. Okay. So I returned them all of them three together. Please sort out this problem because under DGFT foreign trade policy they say that you can supply the goods up to 1 crore. Other they say no, 2% of your export turnover. And under import, your cap is only 3 lakhs rupees, and per parcel should not be more than 50,000 rupees. Per 10,000 also. So different authorities says different things about the value of export made free of cost. So you need to take your banker and you satisfy your bank that you are taking the goods out of India. If it is very less amount, you can supply as a samples and all, but you will not be getting any government incentives what you supply because the money is not coming from outside for the samples. How to obtain finance for new merchant export? finance is not available for the merchant exporter. You need to keep some mortgage of the property only and only. Because manufacturers are having the factories and fixed assets and capital of the goods and all. So unless and until a merchant is having some type of goods in their stock, okay, as a to keep as a margin with the bank, you will not be getting the finance on that. Has this SOFR replaced? No, SOFR has not come into the picture. LIBOR has been replaced with the AAR. Arrangement with the latest government is what the bank is saying, that AAR rate will apply here. About the international market, dollar rate is going on presently. So LIBOR has been stopped from 31st December. Any chances of increasing GR waiving limit to more than 25,000? Yes, I told you, it is 1 crore or 2% of your total export. Okay, you can supply the without any GR. Is it safe to go for supply chain trade finance? Supply chain trade finance, you can go. It is safe. It's no problem. Some of the companies are already working on India also, so you can discount those documents with them unless and until they are working with you as a without recourse. Without recourse is fantastic. They are taking their due diligence. They are taking the risk on your buy and all, so you can do that. And thank you very much. I think I have finished all the questions.
Thank you, Jagdish sir, for taking the questions so patiently and replying to each one separately. It was great presentation, and may I please request if you can share the presentation on the same with everyone, or email it to me. I will be sending to the entire database who have attended the session today. So tomorrow there will be a session on the Forex. The timing will be same between 3 to 6 p.m. So I request everyone who have attended the session today, or if you have not attended the session, it was live on the YouTube also. We will share the link with you shortly, and looking forward for the next session tomorrow. I hope the sessions were useful and it will help you in build capacity and further enhance the trade and optimize your business potential. Thank you very much.
Thank you very much. Thank you all of you, and thank you
day
TPCI
today.
also, and thank you Samir sir also. And please be present tomorrow. If you have anything, I will take your question tomorrow also. Thank you very much.
Thank you, sir. Thank you for your help. Please share the presentation.
Yeah, sure. I will be sending it to you right now.
Thank you, sir.
Thank you.
Goodbye all. Take care. See you tomorrow.